Well, as I mentioned, we have Jerome Niedorf, a mortgage banker broker, and also one of the two heads of the Six Steps Home. Welcome back to the show, Jerome.
Good morning.
Okay, Six Steps Home are 6 steps in which people who thought they couldn't buy a home, well, when they go through your workshop, will be in a better position to do so. So let's do a little review and then get on to the next lesson, quote unquote.
Okay, over the last number of weeks, we talked about how much of a payment they can qualify for, what is countable as far as income, how much of a house payment they should have with the current debt that they have right now. And what we're going to talk about today is money.
Okay.
And how much down payment they're going to need.
All right, let's start with the down payment. How is that determined?
Okay, depending upon the type of loan they're doing, let's just take a $200,000 purchase. If you're doing an FHA loan, you need to have a $6,000 down payment. If you're doing a conventional loan, you need to have a $10,000 down payment. And that is just the down payment portion. Then we're working with closing costs, and we're also working with the fact that after they're done and ready to move into their house after they close, they have to have some money left over in the bank because they need to, sign up for utilities and everything else.
How is that determined? In other words, when you're saying $200,000 and you need, how much was it for the FHA?
For FHA you got a 3% down payment on FHA guidelines. Okay, so that's $6,000.
$6,000. But it's not a $194,000 loan, though, is it? Aren't there some of those other costs that can be built in there?
We have the ability to finance a portion of the upfront FHA insurance, so it's actually a tad higher than that so that they don't have to come out of pocket with that money. But then you also have other closing costs like the appraisal and title work, and you have to buy homeowners insurance, and you've got a tax bill that needs to be paid, and so on and so forth. And the nice thing about FHA right now, a lot of the sellers are willing to pay those costs for the buyer, so all they need is the $6,000 to get into the house.
Is this strictly on resale homes, or is this on new homes as well?
It's on new homes, providing the home was built per FHA guidelines. So typically what you run into, a lot of it is used on resale.
Okay, so we got the money. Then what's the next thing we need to address?
We need to address the type of loan program then they're going to go into, because if you're doing an FHA loan, you can go up as high as $304,000. So you do a $300,000 purchase, your down payment naturally is $9,000, 3%, but that's also less than the 5%, which would be $15,000 the conventionals need. So I guess what I'm saying is right now, FHA financing is very, very popular.
Okay, and what would be the next step that people should look for?
That's probably it. There's sources of money. The money we typically need to document for the last 60 days, okay? If they don't have down payment money, we have the ability to have a direct line blood relative give them the money. I've got 2 FHA loans in process right now that family members are giving them the down payment money that they need to get in. On conventional guidelines, you can't do that.
Okay.
Only FHA.
Now, let's take it a step further. When you and I were at a meeting over at Power Realty early in the week, one of the things that came up was that people still don't realize that they need to be pre-qualified.
Well, not only do they need to be pre-qualified, they need to be pre-approved. Okay.
Okay.
There's two different segments here. Now, typically, if someone's going to buy a home, whether it's owned by an individual or if it's an REO that a bank owns because they foreclosed on the house, when they make an offer, they have to have an approval letter. And typically, I like to treat it as a 2-step process. Okay. The first step is we typically talk on the phone, or they can come into my office and sit down and talk, and we talk about what their income is, how much they have for current debt right now, so we calculate how much of a payment they can qualify for. We talk in general, have you had any credit issues? Is there anything there that you're aware of we need to work with? And how much money do you have to work with? That's a pre-qual, because the pre-qualification will tell us here's what price range you should be able to get approved at. Now, if they're going house hunting, they need to come in, do an application, and have a regular approval, especially with the REOs, the foreclosed properties. when the banks take a look at an offer, they expect an approval letter there. They don't want a pre-qual letter that, yeah, according to what this person told me on the phone, they qualify. They want an underwriter or an automated system to have already evaluated that borrower. Is this an approvable loan subject to contract and prelim and appraisal and so on and so forth? Now, a lot of times on an individual seller, the realtor can say, oh, this person's good, go ahead and accept the offer. From what I'm hearing from, for example, Power Realty that does a lot of bank-owned properties, there's no emotions involved. No, you have to have an approval letter. You can't make an offer on a REO property, a foreclosed property, without a full approval. They just won't take the offer. There's been too many people that have written an offer, 60 days later or 30 days later, they find out they don't qualify. They don't want that to happen.
One of the things I keep reading in the news, though, is the fact that you can have excellent credit and still not get a loan.
Oh, absolutely, because it's all of the factors together. You have to buy within the price range that you qualify for. Okay. Your money has to be countable and usable, right down the line. Credit is one piece. Income is another piece. Down payment is another piece. And then selecting a loan program that fits that person's needs. So it's a whole lot more than just credit. And
okay, so basically what I'm saying, that pre-approval letter says that, okay, you have met all the criteria, and therefore you can go ahead and make an offer on that home, and if that offer is accepted, we can get you the financing. Is that correct, or is there still something that could enter into it?
That is exactly correct, because at that point we've seen the bank statements and the money is verified, and it's whether it's gift funds or whatever, not a problem. We've seen the paycheck stubs and W-2s. We know what the income is. The credit is already in. The whole package is done complete. It's underwritten right up to the fact, now go buy a home.
Now, do you mind, as a lender, going through a bunch of numbers to get those people who are actually qualified? In other words, are there mortgage companies that say, wait a minute, I don't want 300 people calling me to get pre-approved when they already know up front? Are you?
Interestingly enough, it's very important to have the initial telephone conversation before we sit down to actually do a loan application, because these people may think they qualify for a $400,000 home, but indeed it should be a $250,000
so in other words,
home.
The fact that they're not qualified for a $400,000, they could be qualified for a $300,000.
Correct.
Which just changes their whole mindset of A, do I really want to buy a house, or B, I've got to look for houses in that price range.
Correct. Or you get into the credit issue. Talk to someone.
I am going to have to interrupt you. We're going to get into credit. Okay. Our time is up, but I need people to get a telephone number from you so that they can answer it, because we hit upon something big that should make your phone ring.
Okay, 595-4118 is my cell phone number.
Okay, and I know you're going back to Iowa. Hope you have a good trip back there.
Very good.
But let's talk about this credit thing, and thanks for being with us.
Very good.
Okay, commercial time, and then we're going to meet up with our next segment here on the House Detective.